If you are earning over $1 million a year, this episode is going to be one of the most valuable 20 minutes you will spend in this season because we are breaking down a strategy that lets you give, defer, and grow all at once. So, if you are preparing for a business trip, planning a major stock liquidation, or simply looking for a smarter way to build a legacy while minimizing taxes, this video is for you. We'll go through 6 key points, each one building on the next. So as we go, I will remind you exactly which part we are in so you know where we are in the story and what's coming next. Here is the roadmap for what we will cover together. So part 1, the foundation, what a charitable remainder trust really is. Part 2, why 2025-26 is the golden window for the strategy. Part 3, a client story that shows this in action. Part 4, a complete step-by-step implementation guide. Part 5, advanced planning layers beyond 2026. Part 6, the triple win framework that ties everything together. So if you are someone earning 7 figures and you are looking for a strategy to reduce taxes legally and strategically, let's get to it. Okay, so welcome to part 1. Let's start simple. What exactly is Charitable Remainder Trust, or CRT, and why do so many high earners use it? So here's the big picture. A CRT is a tax-exempt trust under the IRS Code Section 664. It's the structure that allows you to move appreciated assets like stock, real estate, or even business interest into the trust. Lest the trust sell those assets without triggering capital gain tax immediately. Receive annual income from the trust for life or for a set number of years, and get an immediate charitable deduction for the portion that will go to charity in the future. In short, you donate assets, but you keep income and tax savings. And when the trust eventually ends, the remainder goes to your chosen charity or your donor advised fund. Now, why is it a powerful tool for million-dollar owners? Because when you sell high-value assets personally, the IRS can easily tax 20 to 37% or more in combined federal and state taxes. But a CRT lets you redirect that money into an income stream that compounds instead of evaporating in taxes. So, as we wrap part 1, here's your key takeaway. A CRT isn't just for the ultra wealthy. It's for anyone who wants to turn a taxable sale into lifetime income and legacy plan. Next up in part 2, we were looking at why timing is everything and why 25-26 tax window is so crucial. Let's move on to part 2. So welcome. Now that you know what CRT is, let's talk about why this strategy matters right now. Under the Big Beautiful Tax Bill, we are in a period of historically low income and capital gain tax rate, but the rates are scheduled to rise after 2026. So, for high earners, this creates a temporary window to make large charitable moves and capture deductions when they matter most. Here's what you need to know right now. So charitable deductions are still capped at 60% of your AGI for cash gifts and 30% for appreciated property with a 5-year carry forward. CTRs let you defer gains for appreciated assets while immediately locking in those deductions. The trust itself grows tax-deferred, and your personal income from it can be structured to fit your financial goals. So let's be clear. The strategy isn't about giving all away. It's about redirect your money in a way that benefits both you and the causes you care about. So if you are watching this before the end of 2026, you are in the perfect planning window. because when the tax rate will get higher, that same deduction and same strategy will give you less bang for your buck. So next in step 3, let's bring this to life with a real story, how one of our high-income clients used a CRT to sell a business, reduce taxes, and still receive steady income for life. So let's talk about Evelyn's 9 million exit plan. Welcome to part 3. This is where we make all the theory real. Let me introduce you to Evelyn Chen, a 52-year-old physician from San Diego, California. In early 2025, she sold her medical practice for $2.9 million after 20 years of ownership. Her challenge? Nearly half that value were appreciation and goodwill, meaning a massive capital gain bill would come in her way. If she sold directly, her total tax bill would have been about $2.1 million between federal and state. Evelyn didn't want to lose that kind of wealth. She also didn't want to stop working. She just wanted more flexibility, predictable income, and the ability to start a scholarship foundation in her name. Here's what we help her to do. Before the sale closed, she set up a Charitable Remainder Unit Trust, CRUT, across. She transferred 40% of her business ownership to the trust. The trust sold its shares tax-exempt and reinvested the full proceeds. Evelyn started receiving 5% annual income from the trust, about $184K per year for life. She received a $1.8 million charitable deduction on her 25 tax return. That deduction lowered her taxable income significantly and dropped her effective tax rate by just 17%. Meanwhile, her trust kept going, and the remainder will eventually fund a scholarship foundation for future doctors. So think about that. Evelyn didn't give money away. She redirected it. She turned $2 million tax bill into a lifetime income stream and a legacy that carries her name. Now, that one case that I want to show you exactly how it works in sequence. Let's move into part 4, where we'll go through the full step-by-step process. We can visualize each stage. So let's move to part 4. This is where it gets practical. If you are watching and thinking, oh, how do I actually set it up? This part is for you. Here's the 9-step implementation framework. Step 1, identify your appreciated assets. So this could be stock, real estate, or part of your business. So the bigger the unrealized gain, the bigger the benefit. Step 2, assemble your advisor team. You will need a CPA and an estate attorney and possibly an evaluation expert if it's a private health business. Step 3, create the trust before the sale. The timing is critical. The trust must own the asset before it's sold, so you will lose the deferral benefit. Step 4, choose your trust structure, like a cross-fund unit trust. Give variable income based on annual value. A CRT, like an annuity trust, gives fixed annual income. This is something you want to discuss with your estate attorney and also your CPA to select which one is best for you. Step 5, fund the trust. So you transfer ownership into the CRT, meaning the trust now owns the asset. Step 6, the CRT sells tax-free. It sells the asset, reinvest the proceeds, and pay you from the earnings. Step 7, so you receive the annual income. So that payout is at least 5% per year and can continue for life or for a term of years. Step 8, claim your charitable deduction. You will take it on your tax return the year you fund the trust based on IRS Section 7520 interest rate. Step 9, maintain your CRT each year. Your trustee files Form 5227 annually, and you will get a Schedule K1 for your income reporting. If you are following along, the step-by-step process can be summarized in one sentence. Set it up before the sale, let the trust sell tax-free, get income for life, and leave a legacy. Next up in part 5, we will go to level this up even more by layering other tax strategy on top of your CRT for maximum impact. So welcome to part 5. This is where advanced planning meets long-term wealth design. Because once you have set up your CRT, you can combine it with other strategies to extend the tax investment advantage beyond 2026. Here are 5 layering techniques that high earners use. First, front load your contribution. So front your CRT while income and tax rate are still low, which is why now is a good time because this time frame the interest is still low. The tax rate is still low compared to future projection, right, when Congress decide to change it. 2, pair it with a Roth conversion. So use your CRT deduction to offset the taxable income from converting to a Roth IRA. 3, split the sale. It's selling a business, so put part in a CRT and part in an installment sale to spread income over time. So this is something that you can really run your numbers, see which one is better for you. 4, add family beneficiary. You can name your spouse, your adult children as income recipients with proper estate and gift tax planning. 5, funnel the remainder into a donor-sized fund so you can keep the flexibility over future charitable distribution long after you are gone. This is how strategic giving turns into a lifetime wealth plan. It's not charity for charity's sake. It's legacy design for tax-smart wealth builders. And now we are entering our final section, part 6, where I will show you the triple win framework that explains why it works so well for million-dollar earners. So let's in part 6, and this is where everything comes together. If you remember just one thing from this video, make it this. A charitable remainder trust gives you 3 wins at once, what I call the triple win. So win number 1, immediate deduction. So you get an upfront deduction the year you fund the trust, reducing your current year AQI. Win number 2, deferral of capital gain. The trust sells your appreciated assets without paying capital gain tax immediately, keeping more money working for you. Win number 3, lifetime income. You receive steady payments, often for life, creating predictable cash flow while maintaining your philanthropic goals. And here's the bonus win number 4, estate exclusion. The assets inside your CRT grow outside your taxable estate, lowering future estate taxes. So the big message here is this isn't about losing control of your money. It's about using the rules strategically to create income, reduce taxes, and expand your impact. Let's recap where we are before we close. So we covered 6 different parts from the basic of CRTs to advanced planning layers. You have learned that a CRT is why 25, 26 the key opportunity, how to set it up step by step, and how real clients like Evelyn use it to reduce millions in taxes while funding a charitable legacy. So if you are a high income earner, business owner, or investor with appreciated assets, this is the time to act. Plan before you sell, design before you donate, and always structure your giving with the same precision you apply to your investment. Because the best tax strategy doesn't just save you money, it shapes your legacy. That's how million-dollar earners give, default, and grow all at once. Thank you for watching. I will see you in the next video update.